How does a bank know what I can afford? This is a great question that we obviously at mlenow.ca, as people are sending us their information and getting us to help them with their mortgage or loan, this is a pretty big conversation piece. How does the bank actually know how much I can afford? Well, there's two things that you should know. First of all, for residential property, so if you're buying a home or investment property, there's sort of one way that a bank will figure that out. If you're looking at a business loan or you're looking at a commercial mortgage, there's sort of a second way that the bank will do it. So there's two different calculations they use, but at the end of the day, the banks are looking to do the same thing. What they end up doing is they say, look, if you're looking to buy a residential home or an investment property, we will take a percentage of your income and we will allow you to use that percentage of your income for the mortgage, the associated costs of that property, plus your other debts. And that number tends to be around 42%. So depending on how much money you make, 42% of that is how much the bank will use to calculate how much you can afford for a mortgage. So they'll say, okay, well, if you make $100,000 a year, we will allow you to spend $42,000 a year on your Visa payment, your MasterCard payment, your car lease, and your mortgage and housing costs. And so after they've deducted out your other debts, they take whatever is left and then they determine how much of a mortgage you can afford from that. If you are a business looking for a commercial mortgage or you're looking for a business loan, the bank, the same principles at work, but they calculate it a bit of a different way. What they say is for every dollar of debt that you want to borrow, so if you want to borrow $100 or if you want to borrow $100,000, whatever the payment is on that debt, if it's $1,000 or $1,200, we need to see that you have 1.25% more than that. So basically, for every dollar of debt you have, we want to see $1.25 of net income. So gross revenue, how much money did your business make, less all of its expenses means you've got something left over. Whatever is left over has to be 125% more than whatever your annual payments are going to be. So in both cases, really what the bank is trying to do is they're trying to say, look, we want to make sure that we don't take all of your income to make debt payments, because there are still other payments or other expenses rather, that you're going to have to take care of. And so we don't want to see all of your income being used to pay for debt. So there are specific calculations that the bank uses, and based on whatever amount they're using, they end up applying an interest rate to it, which ends up telling you how much you can afford. So the higher the interest rate, the less you can afford. The lower the interest rate, the more that you can afford. But that too has a bit of a threshold. If you're looking for a line of credit, or you're looking for a variable mortgage or variable loan, the bank will not use that interest rate to figure out how much you can afford. So for example, a variable rate mortgage is, let's say it's prime, let's say it's 3%. Well, the bank is going to calculate how much you can afford based on what are called posted rates. So a 5-year rate might be 4.29%. That's what they're going to calculate how much you can afford. They're not going to use the 3% because variable implies that it is variable. It can go up, it can go down, and the bank wants to know that you're going to have sufficient income in the event that interest rates do start rising. And so they're going to calculate out your ability to qualify based on a higher interest rate, even though the actual interest rate you receive will be lower. So here's what you need to know. It isn't a black box when the lender tries to figure out how much you can afford. They really take and there's a lot of other variables that are involved, but they in essence take your income and they will apply some very simple math to it to figure out how much of your income can be used to make debt payments. And those debt payments will be inclusive of not only your loan or mortgage that you're applying for, but the other debts that you or your company might have as well. So go to mlenow.ca, and if you're looking for a mortgage or a loan, all you need to do is punch in the amount. If you're looking for $500,000 for a home, or you're looking for $5 million for a building, go to mlenow.ca, punch those amounts into the main page, and from there you're going to be able to see how much income you're going to have in order to qualify for those amounts.